Hi, everyone. Welcome to Questrade's webinar series. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. Joining me shortly is our very special guest, Adrian Bar, better known as Canadian in a T-shirt from YouTube. Before we introduce Adrian and kick off the event, let's go through the agenda and some important notes about the webinar. First, we'll cover some important information about submitting questions during the event and when the on-demand video recording is going to be available. Next, I'll introduce our special guest before we move on to the event. We'll cover the basics of the RESP account, how they work, and how to get the most out of your contributions and grants. In addition, we'll also explain how withdrawals work when it's time to go to school, or if your child is not going to post-secondary. Lastly, we'll wrap up with a live question and answer period near the end of our webinar today. So today's session will be recorded, and we'll have the on-demand version available next week. If you have to head out early or would like to rewatch an important section, we've got you covered. Please keep an eye on your email inbox for the recording. And if you have any questions during the presentation, please type them into the Zoom Q&A window available at the bottom of the Zoom interface. That's the Q&A window and not the main chat window. Our agents can help answer simpler questions throughout the presentation, and we'll be hosting a longer question and answer period near the end of the webinar today. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. And here's a quick disclaimer. Please remember that the information conveyed in this webinar is for informational educational purposes only and does not constitute advice or recommendations by Questrade. And all right, moving on. Without further ado, I'd like to introduce our special guest speaker today, Adrian Bar, better known as Canadian in a T-shirt from YouTube. Adrian's the founder of the YouTube channel Canadian in a T-shirt, where he breaks down personal finance, investing, taxes, credit cards, and small business ownership for everyday Canadians. In his videos, Adrian walks investors through everything they need to know about building long-term wealth in a format that's accessible even to absolute beginners, but with strategies that can still appeal to more experienced investors. As Adrian says, you work hard for your money, so make sure your money is working just as hard for you. Thank you again for joining us today, Adrian. Take it away.
Thanks, John. It's my pleasure to be here. Thanks for having me. So we'll start off first with what exactly is the RESP and how does it differ from the RESP, the TFSA, and the RRSP. So right off the bat, the RESP is the Registered Education Savings Plan. And this is a tax-sheltered investment account, but unlike the other ones, this is specifically designed for Canadians with children. It's designed to fund your child's post-secondary education. And with the RESP, you really get the power of two main benefits. One, you get free money from the government in the form of government grants. And two, you get tax-sheltered growth. And unlike the TFSA and the RRSP, which are available to all Canadians, you can only open up an RESP after your child is born. It can be opened up by you as the parent or a grandparent, an aunt or uncle, or other family members. And just like the TFSA and the RRSP, the name itself is quite misleading. It has the word savings in it, but you should not be using this as a savings account. The RESP is meant to be used as an investing account where you can hold things like stocks, bonds, ETFs, REITs, and hold them in a broker like Questrade, which is my favorite online broker in Canada. You can also hold things like mutual funds, GICs, and cash. But again, you really want to focus on investing with an RESP. And one of the benefits of the RESP is that the tax sheltered nature is very similar to the TFSA. And what I mean by that is all of the investment income you earn inside the RESP is tax-free. So things like dividends, capital gains, interest, drips, all of that is tax sheltered as long as it remains inside the RESP. Once the money is eventually withdrawn, then it may be subject to some taxes depending on the type of withdrawal and the tax bracket of the student in question. But we'll cover that later in the video. An important thing to note is that contributions you make to the RESP are not tax deductible like the RRSP. With the RESP, the contributions are made with after-tax dollars, just like the TFSA. So whenever you put money into your RESP, you won't be able to reduce your tax bill, but you will help reduce future taxes on that investment income. It allows your investments to grow much faster tax-free in an RESP than it would in a non-registered taxable account. Another difference is that with TFSA and RRSP, the withdrawals are much more flexible. You can essentially withdraw the money anytime and spend it on anything, even though it's designed for retirement. with the RESP, that money is designed to be spent on education, post-secondary education for your child. You can't just withdraw it and spend it on whatever you want. It's meant for school. So remember, with the RESP, there's two main benefits of the RESP that the TFSA and RESP don't offer. So they all offer tax shelter growth, but the difference with the RESP is that you also get free money from the government, up to $7,200. And the real power of the RESP is that you get to invest both your money and the government's money, and you get tax shelter growth on all of this money.
Awesome. Thank you so much, Adrian, for giving us a brief introduction about RESPs. So we're going to move on to a quick section here covering some of the differences between individual and family RESPs. So what are kind of the main differences and which one should I choose depending on kind of my family's needs?
Absolutely. So with an individual RESP, it's meant for one child. So you open it on behalf of only one child. And that way you can kind of tailor make your investment portfolio for that child, knowing that they're going to, go to university at 18 years old and they'll need the money then. However, one of the benefits of the individual RESP is that it's a little bit more flexible with who can open and contribute to the individual RESP. It can be opened by a parent, a grandparent, or other family members like aunts and uncles and siblings. But an important note is that even though more than one person is contributing to an individual RESP, that the contribution limits are shared among all those accounts, right? So if you and the grandparent are contributing to the RESP, make sure you coordinate so that you both don't exceed that child's contribution limit. The other type of RESP is a family RESP, which are meant for more than one child. And with the family RESP, basically you pool together all of the investment funds for your child and all their siblings, right? They all kind of share one giant pool of funds and they all grow tax-free. However, there are a few more restrictions with who can contribute to a family RESP. Only a parent or a grandparent can contribute to a family RESP. But one of the main benefits is that since this money is it's a shared pool among all the siblings, it allows for a lot of flexibility when if one child decides not to go to school, they can easily transfer all that accumulated income into a sibling's RESP. So that's one of the main benefits of the family plan.
All right. Thank you so much, Adrian. That's a really great kind of quick introduction between the two kinds of plans. And we are going to go into a little bit more detail about withdrawals and some of the pros and cons versus individual versus family a little bit later on. The next section here, we're going to move on to contribution limits and government grants. So how does this CESG or Canada Education Savings Grant work? And how much should I be depositing each year to kind of maximize my growth?
Absolutely. This is the fun part of the presentation. So when it comes to contribution limits, there's two limits we need to really pay attention to. One is the lifetime contribution limit. That's how much money we as the parent can put into the RESP. And for each child we have, we can contribute up to $50,000 of our money. Remember, this $50,000 is only the money we put in. It doesn't include the tax-free income or the government grant money. On top of that, we also have the CESG grant limit of $7,200. That's how much money we can get from the government. And I'm going to cover in the next few slides my contribution strategy on how to maximize this free money from the government. So with CESG grants, the way it works is that whatever money you put in as a contribution, the government will match 20% of that, up to a maximum of $500 per year. And these government grants, they stop at the end of the year when your child turns 17. So as an example, if you put in $1,000 into your child's RESP, the government will match 20% of that. So the government puts in $200 totally for free. That's basically a guaranteed 20% return of your investment. That money comes straight from the government, and you don't have to even worry about, how to invest it or whatnot. Like, even if you leave it as cash, that money, if you make that $1,000 contribution, that $200 will come from the government and go directly into the RESP. So this is the real kind of main power of the RESP, and you really want to make sure you make the most out of these government matching grants. So, and again, one of the other kind of benefits of the RESP is that you put in your money and that goes tax-free. But whenever you put money, the government matches that grant and they give you money as well in the form of grants. And what's really amazing about the RESP is that both your money and the government's money will grow tax-free for 17, 18 years, until your child finally needs that money to go to school. And that is an enormously powerful benefit. And because of that, we really want to maximize that grant money as soon as possible. The earlier we can put our money and the earlier we can get that free money from the government, the more time we have for our investments to grow. So you really want to start contributing to the RESP as soon as the child is born to maximize that compounding growth. Remember, when it comes to investing, time is your biggest ally. So you really want to make the most of it. So with the government CESG grants, remember, there is a lifetime grant limit of $7,200. And here's the strategy to kind of make sure you get this maximum money from the government. So if you contribute $2,500 every year into the RESP per child, you're going to receive 20% or $500 from the government. Remember, the government won't match any contributions above $2,500 for the year. That's why you want to, even if you have more money, you really want to limit yourself to $2,500 of contributions every year per child. That way you get $500 from the government, right? So you do that, you put in $2,500 every year. After 14 years, you've put in $35,000. And the government has given you $7,000 of free government grant money. Now, but remember, we have a lifetime grant limit of $7,200. So we only have $200 left of grant money remaining. So in the year 15, we don't contribute the full $2,500. We only put in $1,000. And then the government gives us our final 20% match of $200. And at this point, we've received the maximum amount of government grants of $7,200. Now we're fully maxed out. So at the end of 15 years following the strategy, we, as a parent, we've contributed $36,000 and the government has given us $7,200. Now the government grants are maxed out. But remember, the RESP contribution limit is $50,000. So, and that's the money that we can put in. So we still have $14,000 of contribution room remaining, even though the government grants are maxed out. So now what do we do? Well, here's what I suggest. If you have TFSA room available, I would recommend that you prioritize the remaining money you have that you're kind of designated for your child and put that into your TFSA. Because once the government grants are maxed out, you're not getting any more free money from the government. At that point, once the grants are maxed out, the only benefit of the RESP is the tax shelter growth. That's the exact same benefit you get from the TFSA. However, with the TFSA, it's a lot more flexible when it comes to making withdrawals. But let's say that your TFSA is maxed out. At that point, absolutely, you should try to max out and put in that remaining $14,000 into your child's RESP, right? You're not going to get any more free money from the government, but you still get the benefit of tax shelter growth. And that cannot be overstated. When it comes to really investing, like there's no reason to pay taxes on your investment income when you have tax-free room waiting for you. So make sure you take advantage of that. And another thing to note is that once the government grants are maxed out at the year 15, there's no real benefit of kind of pacing yourselves anymore and putting in only $2,500 per year. If you have $40,000, you can dump it all at once into your child's RESP, because since the grants are maxed out, there's no more benefit of kind of stretching it out. Put money in as soon as you can to give your investments more time to grow tax-free.
Amazing. Thank you so much, Adrian. That was a really, really good comprehensive overview of how the grants work, and really appreciate that personal touch on how you would invest kind of for your kids and things like that kind of moving forward. Absolutely. And awesome. Let's move over to why RESPs specifically. So how much can I expect to have saved up for school over 18 years? Is this going to be enough to pay all my costs, tuition, rent, that sort of thing?
Absolutely. So good news is that if you follow a quite conservative and realistic RESP strategy, the RESP alone will certainly be enough to cover your child's post-secondary education, right? And let's look at some numbers to kind of, I don't want to kind of, intimidate you, but kind of incentivize you for why you really need to start taking this seriously and why you need to start saving up for your child's education as soon as possible. Remember, when it comes to investing, time is your biggest ally. You don't want to wait until your child's in high school to start saving up. If you start investing right when your child is born, you can easily and stress-free, You'll be put at ease knowing that your RESP will be enough to cover your child's tuition and education costs. So looking at some numbers here, the average tuition cost in Canada right now is over $6,800 per year. And that's just tuition. And that's tuition for a regular undergrad program. On top of that, if you're doing a professional program like engineering, pre-law, pre-med, those can be significantly more expensive, right? On top of that, not only do you pay tuition, you also have to worry about the cost of textbooks, rent, dorm accommodations, food, transportation, all those things add up. So over the course of 4 years, you could be looking to spend over $80,000 on a child's education, right? I'm sure a lot of us have been in that boat. We know how much it costs and we know how much it can hurt, right? So if me as a child, if I knew that I had my parent was investing in RESP, it would really, really put my mind at ease knowing that all this money is basically covered, right? So looking at the strategy that I just talked about in the previous slides, right? Over the course of 17 years, if you follow that strategy and using a very conservative stock market rate of return, we can expect to earn over $86,000 into our child's RESP. So that money alone can more than cover the average cost of post-secondary education, university, college, whatever it's going to be. So let's kind of break down this example, how we got this $86,000. So remember, if we follow my strategy to max that government grant money, we put in $2,500 every year, and the government adds on $500 of grants every year. And now we let that money sit and invest and compound for 17 years. After 17 years, assuming a very conservative rate of return, a rate of growth of 6%, we would have accumulated over $86,000. And the true amazing fact about this is that more than half of this money did not come from you, right? A lot of that money, $7,200, came from government grants, and the biggest chunk of money came from that tax-free growth. This is the true undeniable power of an RESP, and that's why you should use an RESP. Let's break it down a little bit deeper, right? So after 17 years, we have $86,000. Remember, we've been putting in $2,500 every year for 15 years. That gives us $36,000 because we stopped at the end of the year 15 when the government grants maxed out. On top of our contributions of $36,000, the government gave us $7,200 totally for free. And now our money and the government's money, we're growing and investing tax-free. And that tax shelter growth earned us over $43,000. And remember, we're using a very, very conservative rate of return of 6%, right? But even with such a low rate of return, you can see how powerful this is. What if we use a little bit more, a more optimistic and frankly, a more realistic rate of return? So let's look if we were investing in the S&P 500, which is basically the top 500 companies in the US stock market. Historically speaking, if we invested in broad index funds, ETFs that track the US stock market, we weren't doing anything fancy. We were just investing in the US stock market. Historically speaking, over the past 20 years, we would expect a rate of return of 9.2% every single year. And if we do this in our RESP, that 9.2% of growth every year is tax-free. And you can see here, over only 15 years, we've earned over $97,000 in the RESP. Remember, only $37,000 came from us. The government grant money was $7,200, but the biggest chunk of money and the true power behind the RESP is the tax shelter growth, which earned us almost $53,000. And this is only 15 years. If our child's going to go to university at the age of 17 or 18, add on another 2 years, we're looking at almost $120,000 of money invested in the RESP, ready for your child to use when they're in school.
Wow, that's amazing, Adrian. I know 120 grand definitely would have gone a long way to paying for my undergrad. Oh, yeah. That's amazing. So let's move on to the next section here on catching up on missing years. So let's say my child's 5, 10, maybe even 12, 13 years old already. What can I do to kind of miss up, to make sure I'm not missing out on those years that I didn't contribute?
Absolutely. So luckily, the RESPs got you covered because the unused grant room from previous years when you didn't contribute to an RESP, that grant room isn't lost. You're able to carry that grant room forward. And here's how it works. If you have missing years where you didn't contribute to an RESP, you can double your RESP contributions and earn yourself an additional $500 of grant room from those missing years. This allows you to catch up 1 year at a time. So to make it easier, let's break down a little example. So normally, the normal strategy is we contribute $2,500 into our child's RESP, and the government gives us $500 of grants every year. But let's say we had a really bad year, we lost our job, and that year we couldn't afford to put any money into our RESP. Now we have $500 of unused grant room, and that grant room gets carried forward to future years. So let's say next year we're employed again, we have money to save, and we want to catch up and make up for that missing year. Now we can double our contribution. We can put in $5,000 into our child's RESP, and the government will give us $1,000 of grant room. $500 is the regular grant money we get from 20% matching, but we also get an additional $500 of unused grant room from the previous year. So this way you won't miss out on any of those, on any grant money that's waiting for you if you decide to invest later in life, or if you miss a contribution year because you didn't have the money at the time.
Awesome. Thank you so much, Adrian. Just a quick note also about catching up. Just for administrative purposes at Questrade, if you are catching up on previous missed grant years, we prefer that you split your deposit up into 2 transactions just to make it a little bit easier for us to process on the back end. So just keep that in mind. If you are catching up on a missed year for an RESP, just separate that $5,000 into 2,500 and 2,500. You don't have to separate it by date or anything. Just 2 transactions makes it a lot easier on our side to kind of process the grants for you and everything like that.
Wonderful.
All right, so let's move on to almost the last section here on withdrawing from an RESP. So say your child's 17, 18, 19 years old, time to go to school. What are all these different acronyms? What's the EAP? What's the PSE? What are all these different kinds of withdrawals? Right. And what do I need to know?
Absolutely. So this is when the RESP starts to get a little bit more complicated. Up until now, we've talked about the fun stuff, the free government grant money, the tax shelter growth. Here is one of the parts. This is why the RESP is a little bit more, is less flexible than the TFSA and the RRSP. So before we jump into how the RESP withdrawals work, we need to keep in mind that when it comes to the RESP, you don't just have one giant pool of money. You really have 3 different buckets of funds. And each of these different bucket of funds are treated and taxed differently when it comes to making those withdrawals. So the first bucket is the contributions. That's your money that you put into the RESP. That's your money. It's the simplest one. You never lose it. On top of that, you also have the government grant money. That's the $7,200 you get from government matching grants. And then for most people, the largest bucket of funds is going to be the accumulated income, the tax-free growth that we've earned year after year over the past 17 or 18 years. And remember, each of these 3 different buckets of funds are treated differently. So let's go through them one at a time. Oh, also, another thing I want to, let's go over some definitions to make sure we're all kind of on the same page to make sure of how this all works. So the beneficiary is the child or the student who will be using these funds from the RESP to pay for the post-secondary education. So the beneficiary is the student, the child. The subscriber is the account holder of the RESP who actually made the contributions, who put the money into the RESP. This is usually going to be a parent or a grandparent, or it could be another family member if you're doing an individual RESP plan. So beneficiary is the student, subscriber is the parent or the person who puts the money into the RESP. And again, I don't want to overwhelm you guys with definitions, but we do have to kind of go over these kind of 4 different types of RESP withdrawals. We're going to break them down, individually throughout the rest of the presentation, but I kind of want to show them to you right now, just so we can kind of get a sense of what each of them means. So the main form of RESP withdrawals is called the Education Assistance Payment, or the EAP. And with the EAP, this is when you're withdrawing, and the withdrawals that you're taking out, this money is coming out of the grants portion, the government's money, and the accumulated income portion of the RESP. The second type of RESP withdrawal is the PSE, the post-secondary education payment. This is a little bit easier because when here, you're withdrawing from your contributions, the money that you put in. You never lose this and you never get taxed on this. This is the simplest form of RESP withdrawal. If your child decides not to go to school, there are 2 other forms of RESP withdrawals, which I'll get to at the end of the presentation. First are capital withdrawals. Again, this comes from your contributions. If your child decides not to go to school, again, this is your money. Since you contributed, you never lose it. So it's quite straightforward. However, if your child decides not to go to school, you don't get to withdraw from the government grants anymore. You have to give that money back. However, you can withdraw from the accumulated tax shelter growth or income that you've kind of grown over the past 17, 18 years. And this kind of withdrawal is called an accumulated income payment, or AIP. There's a lot of rules and limitations and quite heavy taxes to consider when we talk about this. So I'll be saving this until the end of the presentation. So starting off with the main type of RESP withdrawal we'll be doing is the EAP. And this is really where you want to start withdrawing from the RESP. Remember, when you contribute money to the RESP, that's the PSE, the contribution portion. That money is your money. You never lose it. You can't, it's yours. It's never going to be taxed. It's never going to be taken away by the government. However, the EAP, that's the government grant money and the tax shelter growth, that money technically doesn't really belong to you. It's kind of like a gift from the government designed for post-secondary education. So if you're not in school, you will lose or be taxed on some of that money. That's why while your child is in school, make sure they start withdrawing from the EAPs as soon as possible, because you don't want to ever lose any of that money, right? And if your child is not attending post-secondary education, you won't necessarily lose all this money. There are different strategies that we'll cover later in the presentation on capital withdrawals and AIPs. But first, talking about EAPs. So remember, EAPs are the money that comes from the government grants and the tax-free growth over the course of 17 years. And with EAPs, it's really designed to fund your child's education. So that's your child's tuition, cost of living, rent, books, food, any kind of expenses that your child incurs while they're studying at post-secondary education. And this is very important. With the EAP, it's going to be withdrawn by the beneficiary or the student. And the amount that they withdraw is considered taxable income in the student's name. You can also submit a letter of direction, and with the student, the beneficiary's permission, it allows the subscriber, the parent, to withdraw from an EAP. But either way, that EAP withdrawal will always be taxed in the student's name. But this is a good thing, because your student is going to be in a much, much lower tax bracket. And because of that, your student will probably pay very little or maybe even no taxes on this EAP withdrawal. And that's because your student is in such a low tax bracket, especially compared to the parent who's working a full-time job and in a much larger tax bracket. And an important thing to note is that all Canadians, students included, benefit what's called the basic personal tax amount, which is a federal tax credit, which essentially means that for low-income people, the first $14,000 of taxable income, you won't pay any taxes on that, right? So for students, but students get that $14,000 benefit. On top of that, students can also claim tuition tax credits. So for the average student, like I can speak from experience, when I was in school, every year, the first $20,000 of taxable income was essentially tax-free. I didn't pay any taxes on that first $20,000, either from my co-op jobs, my RESP withdrawals, or from my part-time jobs. I got the benefit from the basic personal tax amount and the tuition credits. So even though an EAP withdrawal is taxed in the student's name, realistically speaking, most students won't pay a single dollar in taxes on this amount. And if they do, it will be a minuscule amount, far less than you as the parent would be forced to pay. But with the EAP withdrawals, there are, not only is it taxed under your student's names, there are some limits to it. So when you're withdrawing from your child's EAP, in the first 13 weeks of school or the first semester of school, you can only withdraw $5,000 in that first semester if your child is a full-time student. If your child is a part-time student, the limit is only $2,500. And here's an important point. Remember, when you're withdrawing from the EAP, this money is a combination of the government grants and the tax shelter growth that you've accumulated over the years, right? The capital gains, dividend income, whatever, right? And unfortunately, you're not able, when you make this EAP withdrawal, you're not able to pick and choose where you want this money to come from, right? You can't say, oh, I want all my money to come from the government grants and then all my money to come from the investment growth. It's all done by a formula done behind the scenes. You don't have any control of this. If you make an EAP withdrawal, some of that money is going to come from grants, some of the money is going to come from the accumulated income. And remember, so when you're in the first 13 weeks, the first semester, you can only withdraw $5,000, right, in EAP payments. But if you need more than $5,000 for that first semester, you can withdraw whatever you want from the PSE, from the contribution portion of the RESP. But after the first 13 weeks have passed, the first semester, now there's no more limits on how much you can withdraw, right? As long you can withdraw, you can exceed the $5,000 limit. You can withdraw, $10,000 a year if you want after the first semester, the first 13 weeks have passed. However, the student has to remain enrolled as a full-time student. If your child, takes a year off school, when they come back to school, that 13-week and $5,000 limit will be reapplied. And again, remember this, that whenever you are withdrawing from the EAP, that withdrawal amount will be considered taxable income for the student, right? Again, you can benefit from tuition credits and the basic personal tax amount. So it really will reduce that tax bill. But on top of that, you might want to spread out those withdrawals over the course of 4 years while your child is in school, right? If you withdraw $50,000 all at once, your child, $50,000 is still, they're still going to be in a lower tax bracket than you as a parent, but a $50,000 withdrawal, they will still pay a significant tax bill. If you spread out those withdrawals over the course of 4 years and withdraw, $10,000, $15,000 a year, they probably won't pay any money in taxes. So keep that in mind. And that's the EAPs, which are, remember, when you're withdrawing from the grant portion or the accumulated income. You can also do something called a PSE, a post-secondary education payment. And with this is when you're withdrawing from your money, the contributions that you made to the RESP. And the benefit here is that since this is your money, you put it in, the government doesn't have any restrictions on what you can do, on how much you can withdraw, and it's not going to be taxed, right? Either you as the parent, the subscriber, or the child, the beneficiary, either one of you can withdraw this money and you could spend it on whatever you want. There are no limits on these withdrawals and there's no taxes. Remember, this is your money that you put in and it was made with after-tax dollars. So it's never going to be taxed when you withdraw it. And remember, so it's not considered taxable income. And another reason why people will be using these PSEs is, remember, in the first semester, EAP withdrawals are limited to $5,000, right? So if you need more than $5,000 in the first semester of school, most parents will withdraw from the PSE, the contribution portions, to bolster whatever money the child needs for that first semester of school.
Wow, great. Thank you so much, Adrian, for explaining EAPs and PSEs in really high level of detail here. I know I learned quite a bit here about these two types of withdrawals, and hopefully our audience can take some of that away. Sure. Let's move on to the second scenario here. What if my child doesn't go to school? So let's cover the capital withdrawals, accumulated income payments, and maybe some other niche options we've got there at the end.
Right. Okay. So if your child decides not to go to school, you have a few options, right? We'll start by the best case scenario and work our ways down towards the worst case scenario. So number one, I recommend that you wait and see, right? Your child doesn't have to go to university as soon as they're done high school, right? With the RESP, you're allowed to keep an RESP open for 35 years. And over all this time, that money is continuing to grow and accumulate totally tax-free, right? So if your child is in their late 20s or 30s, they might decide, hey, at this point, I might decide to go back to school. I might go to college or get a professional degree or something like that, right? Give them this option. Keep the RESP account open so that so your child knows that they have this money waiting for them. And if they decide to go back to school, they have that option and they can count that money is there and growing all these years. Another thing to note is that with even if you keep the RESP open for 35 years, but you can't contribute money to your RESP after 31 years. And the matching government grants, that 20% of grant money, that ends after your child turns 17. So that's one thing to note. So remember, best case scenario, wait and see, keep your RESP open. Your child might change their mind and go back to school later on in life. If your child is certain, I am never going to university, I'm never going to college, I'm never doing anything like that, then the next best thing is to transfer the RESP money for that one child into a sibling's RESP. And if you have a family RESP plan, this is very easy to do because all that money is already pooled together into one fund. However, just like with RESP withdrawals, when it comes to transferring to a sibling, the different buckets of funds also have different rules, right? So we'll go over to that now. So if your child doesn't go to school, but your child has a sibling, brother and sister, you can transfer the contributions into their siblings' RESP as long as it doesn't exceed their $50,000 contribution limit, right? When it comes to the grant money, you can also transfer the one child's grant money into a sibling's RESP. However, you still can't exceed that $7,200 of the grant limit of $7,200, right? So make sure you keep in mind whenever if one child decides not to go to school, you want to transfer it over. If your other sibling already maxed out the government grant money, you can't transfer the first child's grant money into the second child since they're already maxed out. In that case, if they have no other siblings, that grant money has to be returned to the government. There's no way to withdraw the government grant money unless you have a child going to school, right? It's not your money. It belongs to the government, and it's designed for post-secondary education. If none of your kids go to school, or if your sibling, your other children already have maxed out their grant money, you can't transfer it over. However, the accumulated income portion, that the tax shelter growth over the course of years, that can be transferred into a sibling's RESP, and there are no limits when it comes to that. So keep that in mind. So capital withdrawals, this is what happens when you're withdrawing, your child decides not to go to school, and there's no other siblings that are going to school, or it's an only child, right? At that point, you want to withdraw from the original contributions you made. And remember, since you made those contributions, that money is yours. It's always been yours. It doesn't belong to the government. So you can withdraw it as a subscriber, as the parent, and this money is yours to do as you will. There's no limits on it, and it's totally tax-free because it's made with after-tax dollars. However, you don't want to start making capital withdrawals until you are 100% sure that your child and none of their siblings will ever be going to post-secondary education, right? So the contributions you made, you can withdraw from that money and you don't lose it. However, the grants have to be returned to the government, right? The grant money belongs to the government. It was a gift from the government to pay for your child's education. If your kids don't go to school, you have to give that money back. There's no way around it. However, the investment growth, the tax shelter growth that you earn from your contributions, that money can stay in the RESP account and continue to grow tax-free until you decide to close the RESP account. When you decide to finally close the RESP account, there are a few options you can consider. First off, if you want to just close it outright, the investment growth must be donated to a post-secondary institution of your choice. However, there are a few other ways around this. One thing you can do is that as long as your RESP has been open for at least 10 years, you can withdraw the investment growth portion of an RESP and transfer that growth, the accumulated income, into your RRSP, the Registered Retirement Savings Plan, or you can withdraw it into your bank account, what's called an AIP, which is an accumulated income payment. And we'll get to that just now. So an accumulated income payment, the AIP, that's when none of your children are going to school and you want to withdraw from the investment growth portion of your child's RESP. So this is when you're withdrawing from the capital gains, the dividends, all of that investment income you've earned tax-free over these past couple of years. However, there are certain conditions that you have to meet in order to make an AIP withdrawal. First, the RESP account has to be open for at least 10 years. All of the beneficiaries, so all of your children, all of their siblings, have to be at least 21 years old, and none of your children can be enrolled in post-secondary education. If you have a child enrolled in post-secondary education, remember, you want to transfer that investment growth into their RESP. But if none of your children are going to school, then you can make an AIP withdrawal and withdraw it under your name. Otherwise, after 35 years, the RESP account has to be closed after 35 years. So at that point, you can make an AIP withdrawal. However, an AIP withdrawal really should be used as a last resort because it will be taxed quite heavily. Here's what happens. So when you make an AIP withdrawal, it will be taxed under your name as taxable income. So you as a parent, you're working a full-time job, you're probably going to be in a high tax bracket. So you're going to be paying heavy taxes on this AIP withdrawal. On top of that, the government will also slap on an additional penalty, 20% withholding tax or 12% in Quebec. So this will really, really hurt. So really, you really want to make sure that the AIP withdrawals are kind of as a last resort. A better option is if you have available room in your RRSP, the Registered Retirement Savings Plan, you can transfer up to $50,000 of this accumulated income from an RESP into your RRSP. And this way you avoid that 20% withholding tax and you won't pay taxes on this withdrawal. Because remember, when you make an RRSP contribution, that's tax deductible. So you won't be charged that it won't be considered taxable income if you transfer that money into your RRSP. But of course, you have to have available RRSP room, right? If your RRSP is maxed out, you can't do this. But if you have a spousal RRSP and your spouse has a contribution room, then you can also contribute to the spousal RRSP. Remember, this is an absolute kind of worst case scenario. We want the RESP is really designed for your child's education, for either your main child or the child that you opened up the RESP for, or the siblings, right? If none of your children go to school, then you make these withdrawals. And yes, you'll have to either put them in your RRSP or be faced with that really heavy withholding tax on that withdrawal. But remember, the steps to follow is that if none of your children go to school, first, wait and see. Keep the RESP account open. They might change their mind. Second, transfer the RESP money into a sibling's RESP. That's really those are really the best two scenarios. But if all else fails, no children go to school, then you can make these withdrawals, but they will be heavily taxed. So keep that in mind.
Awesome. Thank you so much, Adrian. You really did a fantastic job explaining those complicated withdrawals. I know that puts my mind at ease, knowing that we've got other options. It's not just this heavy tax penalty. You can kind of put it away in an RSP and things like that if the kids don't go to school. So thank you again for covering that. Before we move on to the Q&A, we'll just finish with one quick section here, some of the key benefits of an RESP account.
Right. So again, I don't want to end on a sour note, right? We're not just talking about the heavy taxes and the penalties and the withholding taxes. We really want to focus on the benefits of the RESP. Why is the RESP so powerful for everyday Canadians, right? And here's why. Remember, you get tax shelter growth in the RESP. That's incredibly powerful, especially over the course of 17, 18 years. But on top of that, what's really special about the RESP that you don't get from any of the other tax sheltered accounts is that you receive 20% matching grants from the government, right? Up to $500 per year and up to $7,200 in total. On top of that, especially if you're in a lower, if you have a lower family income, there are other provincial grants and other federal programs to kind of help incentivize the RESP, and they can give you even more money on top of this CESG grant. Remember, the CESG grant, everyone gets this 20% matching. Other people, especially in lower incomes and depending on your province, you might be able to access even more money from the government. And remember, it's never too late. You can always catch up from unused years if you double up the contribution and make up 1 year at a time. And if you follow these strategies, you invest, intelligently in the stock market, stocks, bonds, ETFs, that kind of thing. Over the course of 17, 18 years, the money from the government, the tax shelter growth, and your contributions, all of those together will be more than enough to finance your child's post-secondary education. And that's what you really want to take advantage of. All right, that's it from my end.
And a very special offer for all our attendees and viewers today. If you don't currently have a Questrade account, you can scan the QR code and click the Open an Account button to automatically get started with one of the two promotions below. This offer is valid for new customers only and includes either your first $10,000 managed for free for a year with our Quest Wealth portfolios, or if you prefer self-directed investing, your first $50 in commissions will automatically be rebated with your new account. All you need to do is scan the QR code, then click Open an Account to get started. And a quick tip, the RESP accounts are under the Education menu. And another exclusive offer for all webinar registrants and attendees. If you signed up for this live event and decide to open any type of Questrade RESP account within 30 days of the webinar, we'll deposit an additional $50 cash bonus in your account to help kickstart your child's RESP. The second exclusive offer is available to both new and existing Questrade customers who open and fund an RESP account before October 23, 2022. Full terms and conditions for both offers may apply. Please check your email or the link on the website during sign-up for more information. Thank you very much. And before we move on to the Q&A, just want to give a big thank you again to Adrian for coming out today and for kind of guiding us through all the ins and outs.
Thank you. My pleasure.
All right, so let's move over to the Q&A period here. I'm just going to take a quick second to read through some of your top questions before we get through them.
Sure, let's do it.
All right, we'll kick things off with a pretty simple one here. From a member of the audience here. Thank you, Adrian and Questrade. I've been following Adrian's videos on YouTube. Great to hear. We've got some watchers in the audience. My question is, what will happen if we invest the RESP money on stocks and lose money? So pretty basic question. Maybe we can talk a little bit about risk tolerance, that time horizon of how long you're investing for.
Absolutely. So if you've been watching my YouTube videos, I've covered this in many of my videos, especially talking about the TFSA and the RRSP, but the same rules apply with the RESP. When it comes to the RESP, you really don't want to be making risky speculative investments in the RESP for two main reasons. One, I mean, there's a deadline on when you need to withdraw that money. Your child is counting on this money in 17, 15, 14 years, whatever, however old your child is. They're going to need that money. So if you do a speculative investment, you put into a risky IPO or something like that, right? And you lose that money, you don't really have the luxury of time to let it hopefully recover and make up for the money you lost, right? Your child needs that money when they're 17, 18 years old. On top of that, if when you make a bad investment and you lose money in your tax sheltered accounts like the TFSA, RRSP, and RESP, you're essentially losing that contribution room, right? You don't get that money back. It's not like you can't just go to the government and say like, oh, I know I maxed out. I put in $50,000, but my investment's tanked. Can I get another $50,000? Too bad. The government doesn't care what you do. The government doesn't care how you invest it. They only care how much money you put in. If you've already put in the $50,000 and you lose it, that money's gone, right? You don't get it back. You can't top it up. You can't make up for it. I mean, you can put in one of your TFSA, whatever other accounts, but the RESP, once the contribution limit's reached, you're maxed out. You can't go back to the government and say, sorry, right? So that's why riskier investments, you should hold that in your margin account or non-registered account, right? The tax sheltered accounts, you really, really don't want to risk losing that precious contribution room. So that's why I recommend, my advice is focus on more, diversified ETFs, more established blue chip Canadian stocks, companies that have been around for decades. They have a long-term future. They're guaranteed to be here and be profitable 20, 30 years from now, right? If a company's not going to be around next year, I definitely wouldn't put my money in an RESP for that company. I wouldn't put my money at all, but especially not in an RESP.
That's great. Thank you so much, Adrian. That was a really great detailed answer. And I think you really touched on one of the main points is that time horizon, how long you have to invest for your children. And unlike an RRSP where you might have 30, 40, maybe 50 years if you start really early, RESPs are maybe a little bit of a ticking clock.
Absolutely. Absolutely.
All right. So let's move on to the next couple of questions here. We've got a few members of the audience just saying hello to the Canadian in a t-shirt. It looks like we got a little bit of a Canadian celebrity here. I love that.
Make sure you like, comment, and subscribe.
Definitely. And the video is also going to be available next week. So we're going to email this out to everyone. So if you missed the first couple of minutes, you missed maybe a question, you want to rewatch an important section, we're going to send that out. And it is going to be up on the Questrade YouTube channel as well. So for everyone to watch later.
Wonderful.
Perfect. So, this is a great question. Wow, there's so many. Sorry, guys, just bear with me 1 second. How long is the Questrade offer valid for? For at least the next 30 days. After the next 30 days, not 100% sure. But if you are interested in opening an RESP, doesn't hurt to open it. Questrade doesn't charge a single dollar to open accounts with us. So completely free to open. And you could theoretically get started and not pay a single cent to get investing. And the promo code. So if you scan the QR code, that's going to take you right to the Questrade website. And if you click on the open an account button, that's going to automatically pre-populate the promo code. Now, for those of you that are already Questrade customers with a TFSA, RSP, margin account or something like that, the promo for the RESP is automatically going to be added onto your accounts afterwards if you've registered for the event. So if you're here or if you signed up, we've got you covered. All right, now back to one more for Questrade before I go back to Adrian. Sorry, do we offer family RESPs? Yes, Questrade does offer family RESPs. So if you're on our main website opening an account, both of the RESP accounts are under the education section in the self-directed area. Or if you're opening a managed Quest Wealth account, you choose the type of account, go through a questionnaire, and then choose the RESP at the very end. Hope that helps answer those. Let's see here.
This is fun. I'm anxiously waiting because I have no idea what the questions are going to be. So.
There's just a big stream of them coming in. So I'm just trying to pick the best ones here. This one's a really great one. So do RESP withdrawals have any impact on OSAP eligibility, maybe other grants from universities, maybe a scholarship or something like that? Would me taking money out of an RESP maybe have an impact on that?
So that's an interesting question. So remember, when you're making an EAP withdrawal, that's considered taxable income, right? So it does, the Questrade or whatever, your broker like Questrade will give you a T4A slip when you do your tax returns. So it is considered taxable income, right? So I guess you can consider it's almost as if you had a job and you made that much money as a full-time job, right? So in terms of that, yes, it could affect certain income thresholds when it comes to OSAP or other kind of provincial education loans or grants or whatnot. Yes. And which is why you should also be strategic when it comes to EAP withdrawals, right? I always suggest it's kind of good to withdraw from the EAP portion first because you don't want to ever lose that money. But if you are worried about meeting a certain income threshold or whatnot, right, then do a PSE withdrawal instead, right? Withdraw from EAPs a little bit but remain below that threshold. If you need more money, make a PSE withdrawal when you withdraw from the contribution portion because that's not taxed at all, right? And spread out those EAP withdrawals over the course of 4 years to really kind of lower that tax bracket, that taxable income every single year while you're in post-secondary education.
Fantastic. Thank you, Adrian. That's a really great detailed answer. And I think for OSAP, one of the main things to take away is most of it is based on your parents' income, but there is a small portion that may be based on the student's income. So just keep those in mind. And you can always double check the government's website for those exact figures and contributions and income levels to make sure that you don't end up potentially losing out on any additional free money that you could be eligible for. And as a quick reminder, not investment advice, since we can't offer any advice as Questrade, as your broker, right, but we are happy to guide you through, how the grants work, how the contributions work, and things like that. We just can't tell you to invest in stock A, B, or C, if that makes sense.
As tempting as it is for me.
If I knew what the market was going to do tomorrow, I'd probably be a millionaire on the beach, to be honest.
Yeah.
All right. I guess a quick, simple one I can help answer for Questrade. Is there any required tax reporting when you make deposits to an RESP? So the good news is no. So because it's like a TFSA, when you make contributions to an RESP, you can't claim those against your income. So you're not getting a refund or anything like that. So you don't have to keep track of those limits or anything like that. And let's do 2 more questions before we finish things off, just being respectful of everybody's time here. This is an interesting one, maybe a bit of a conversation. So how often are these contribution limits and maybe grants revisited by the government, if you happen to know, Adrian? If maybe you've heard anything? Are they going to raise it with inflation, with these ongoing situations? When was the last time this was maybe changed, if you know?
Okay, that's a really good question. So when it comes to anything with the CRA, or Canada Revenue Agency, almost every year the government will kind of readjust things like tax brackets or tax credits or CPP contributions or the basic personal tax amount, right? There are certain parts of the RESP which do change year to year, right? For example, there is one, when it comes to EAP withdrawals, I don't know if I touched on this, but when it comes to EAP withdrawals, you don't have to show receipts or anything to the government, right? The government doesn't really care what you do with that money. But there are, as long as it's within a certain threshold. I believe for the year 2022, the threshold was, I think the number is $29,000 or something like that. It's in the $20,000 range, where as long as an EAP withdrawal is below that amount, government doesn't care what you do. You don't have to show you don't have to show receipts or anything like that, right? If you withdraw $30,000, $40,000, then the government might be like, hey, what are you doing this money for? Show us, your tuition costs, that kind of thing. And so that amount, that threshold limit, that does change every year, right? Not by a whole lot, but usually it goes up every year to kind of as inflation and stuff goes up. Mm-hmm. In terms of the CSG grant limit of $7,200 and the $50,000 RESP contribution limit, as long as I've been, studying the Canadian tax code and stuff, which has been at least 7-8 years now, I've never seen that number change. Mm-hmm. But again, it's possible it's changed over that time. Realistically, at least for the past 4 years, it definitely hasn't changed. I can guarantee you there. And if it does change, it's almost always going to go up, right? They're never gonna. It's kind of political suicide for a government to kind of take away tax sheltered incentives from the public, right? So if anything, if it does change, they're usually going to increase those limits to the benefit of the people, not to the detriment.
Definitely. I think I can verify, at least going back 4 or 5 years as well, that these amounts unfortunately haven't changed so far, but we can always hope for the best. The TFSA is somewhat indexed to inflation. So with the RESP, maybe in the next couple of years, we'll hopefully see these contribution limits go up. Maybe the grant amounts go up as well. We unfortunately haven't heard any positive news yet, but who knows? It's a bit of an unprecedented situation the last couple of years with inflation.
True.
All right, that was a really thought-provoking question. We'll finish off with one more because we are past 5 o'clock here. Thank you, Adrian, again for your time, and everybody else. I know we're a little over time. Let's find a good one here. Okay, this is a great one. So what qualifies as post-secondary, and is there an age that a child has to reach to be eligible? Can the 17-year-old go, for example, and start withdrawing? And what's maybe the government's definition of post-secondary? We'll do two in one.
So post-secondary education is any accredited university, college, trade school, apprenticeship, anything like that, right? It has to be accredited, but the benefit is it doesn't have to be in Canada, right? It can also be international schools, as long as it is an accredited university, college, trade school, apprenticeship, and then also on top of that, I believe grad school, graduate. I'm not. Go ahead. Yeah,
mostly, yeah.
School, right. Any kind of post-secondary. If it's at a university, doesn't matter if it's bachelor's, grad school, PhD. It's considered post-secondary education. Yeah. Perfect. Oh, and what was the second question?
So the second one, I just clicked. Sorry, give me one sec. I gotta find it here. Oh, it disappeared. Okay, I guess we've lost that one now.
Hold on. Let me think. So we're doing this live, so it's kind of like, wheels are spinning in my head. What does the government consider post-secondary education? And do you have to be 17? Yeah.
Oh yeah, you have to be a certain age.
Yeah. So usually, for most universities, you kind of pretty much have to be 17, right? There are rare circumstances of like 15-year-olds getting accepted to university, but if you finish, it's post-secondary education, right? So if you finished high school, right, whatever age that is, and you go to post-secondary, you're eligible for these RESP, benefits.
Perfect. Thank you so much, Adrian. This has been fantastic. And I know we've still got about 20 outstanding questions here. I wish we had time to sit through and go through every single one of these. Rest assured, we're going to try to follow up and reach out to every single one of you that do have outstanding questions. And feel free to contact our new accounts agents as well. As somebody that years ago used to work on the team, we're happy to help, happy to answer your questions about RESPs, how the grants work. And definitely shoot a like and a subscribe over to Adrian on his YouTube channel as a big thank you for helping us out and coming on the show today.
My pleasure. And to kind of help, share the load with the outstanding questions that we didn't get to, you can also DM me on Instagram, write a comment on my YouTube videos, and I'll try to answer them as soon as I can.
Awesome. Thank you again, everybody, and keep an eye out for the post-webinar survey as well in your browser.
Thanks, guys. Thanks for having me.
Have a good afternoon, team. Bye, everyone.